So very good evening to all of you once again. So today we are in our 13th webinar for Mission Smile. I am Ankit Kanodia, partner and co-founder of SmartSync Services, a SEBI registered investment advisory firm based out of Ahmedabad. Last month, we did a webinar on understanding the QSR sector. We did a bird's eye view of the 6 companies which are there in the sector. And then post the webinar, we did a survey wherein we asked you to share which company you want us to deep dive in. So most of you mentioned about Devyani, and some of you asked about Burger King. So we were planning to present only on these 2 companies, but fortunately or unfortunately, the share price of Jubilant Food over the last 1 month has fallen down a lot. So we thought that some of you might find even Jubilant interesting after that kind of a fall. So we thought that let's speak a little bit about Jubilant as well. So let me just share the structure of the webinar. So we will start with Devyani, then we'll go to Burger King. And in case of Jubilant, we'll not do a deep dive. We'll just focus on a few things because Jubilant is very well covered. And it's a very old company and there are lots of coverage available. You can go and check. The idea is to go through these 2 businesses in detail, then Jubilant, and at the end we will compare the financials and also the valuation of all these 3 companies. And then in the end, we'll look at the risk part. Okay. So I'll just start sharing my screen. It would be great if one of you can. Dhruv, I see you are there. Can you see the screen? My slide?
Yes,
Okay.
absolutely.
Yes, Ankit, you can see it.
So
we can see it, yes.
Great. Thanks everyone. So I forgot to mention one thing. So Dhruv has partnered me in preparation for this. Dhruv has joined us very recently. He's a very young and passionate intern and he's working really hard with us. So he has worked a lot in preparation of this webinar. So whatever questions you have while I'll be presenting, please put it on the chat box so that even if I can't see it, Dhruv can see and probably answer those questions. And from time to time, I'll take a break and we'll have those questions. Okay. So with this, let us begin. So we have already covered the industry part, but just to get some context into why QSR is important. So this particular quote from this book, Sapiens, teaches a lot about what history speaks about growth, specifically in terms of economy. And later on, I'll try to relate it to the QSR industry as well. So to understand modern economic history, you really need to understand just a single word. The word is growth. For better or worse, in sickness and in health, the modern economy has been growing like a hormone-soused teenager. It eats up everything it can find and puts on inches faster than you can count. Now just try to imagine any business or any industry where you have seen multi-baggers in the past, where stocks have multiplied 10x, 20x, 50x, right? It is impossible to find multi-baggers when there is no growth. So growth is by far the single most important factor, not only for economies, but also for the market. Until and unless you have growth, so there keeps on, we keep on seeing the debate between value and growth. But ultimately, value and growth is interlinked. Growth brings value, and value, something will be valuable only when you see some growth, right? Now that was about the past. Now what about the present and the future? So this particular quote was very important and very interesting, uh, which is the second book of Yuval Noah Harari. For the first time in history, more people die today from eating too much than from eating too little. More people die from an old age than from infectious diseases. And more people commit suicide than are killed by soldiers, terrorists, and criminals combined. In the early 21st century, the average human is far more likely to die from binging at McDonald's than from drought, Ebola, or an Al Qaeda attack. So you can see the all pervasiveness of these QSR companies. So McDonald's is just an example he's using here. So that is how important, integral part QSR companies have become in our life now, right? And speaking about growth, fortune favors the brave and stock market favors the growth engine. If you remember, if you rewind 2 years back, when all the companies were falling, the share price of most of the companies were falling, and we were in, say, March, April 2020, and most of the finance companies also saw their stocks beaten down. People were more bullish on an HDFC or a Kotak Mahindra Bank because they were available at a much, how do I say, at a much lower valuation. I remember HDFC Bank and Kotak Bank, both of them were available at less than 3 times book value, which they hardly traded in their last 10 years or even 20 years history, right? Very, very, very rarely you will find them trading at such kind of valuation, right? And at that point of time, Bajaj Finance was available at 5 to 6 times price to book. And general chatter in the investment circle was, it is much easier to bet on an HDFC Bank or a Kotak Bank. But here we are with the benefit of hindsight and the last 2 years company's performance and also stock price performance. You can see how Bajaj Finance has fared against the two big private sector bank, right? So what does this tell us? This tells us one clear thing is that whatever be the value, whatever be the valuation, first preference of market is always growth. So if we are talking about today, there are many commodity companies also which seemingly which might be a very good stock to buy today, because the market today see a lot of growth in that. Not just because it is cheap, but more because market see a lot of growth in them. They have not been performing for the last 10 years because of some cyclicality and economic related issues. And now the economy is towards them. But that doesn't mean that you will ignore the sectors which are probably overvalued in the typical sense of high P or high price to book ratio or high price to sales. Because if you can see consistent growth in any particular sector, you just can't ignore them. You have to pay attention and see whether you find some ideas in those sectors or not. So QSR is one such sector. And today we will cover 3 companies, starting with Devyani International. Okay. So just a brief overview of the company. It is the leading franchisee of Yum brands in India, operating franchises of KFC, Pizza Hut, and Costa Coffee. These 3 are their main mother brands or own brands. This is operated by RJ Corp, which they have a very good shareholding of 63% in the company, and they have a very good history in terms of Varun Beverage. You can see how Varun Beverage, and with Varun Beverage, I would like to share this experience of our team when we were analyzing Varun Beverage when it got listed, we found that Varun Beverage would be is a business where a lot of capex is required, and we don't know whether the management uh, has the right set of mind, whether they'll be able to do that or not. And on top of that, the the stock price was never available cheap. But you can go back and check how the stock has performed. So this is what happens with high growth businesses. Companies which are consistently growing, uh, they would be it would be very difficult to assume that you will be able to get them at cheaper valuation. That doesn't mean to say that we are uh, saying that you go and buy them at any price. But be very realistic when you are analyzing a company which is in a high growth sector and which is showing a lot of consistent growth in sales, profits, and cash flows, right? Then this company did IPO in FY22 and repaid their debts through the IPO proceeds. And of course, they are one of the beneficiaries of the tailwinds in QSR industry. These are the store numbers of Pizza Hut, KFC, Costa Coffee, and then they also have their international operation in Nigeria and Nepal. If you look at the gross profit margin and contribution margin, you can see that from gross profit per se, Pizza Hut and Costa Coffee are much higher, they are much better than KFC. But when you compare specifically KFC with Pizza Hut, the contribution margin in case of KFC is higher, and they have been able to grow much more because of KFC rather than Pizza Hut. In fact, Pizza Hut, they were struggling since a long time, and only recently, by tweaking some of their strategies, they have been able to somewhat turn around the Pizza Hut story. But it is still too early to say that Pizza Hut has become a formidable competitor for uh, something like Domino's or not, because Domino's is still far ahead in terms of the the brand positioning and the customer loyalty. So these are some of the recent store openings for Devyani, and you can very well see the growth in which they have not only increased their stores but also increased their revenue, right? So, and you can see in Q3 FY22 they have added around 81 units, 81 new units, right? And their total store count from 692 in March has gone up to 884. So this is the cluster or the store expansion details of Devyani. Most of the QSRs like Devyani and Burger Kings, they believe in this cluster focus where they will have they'll identify one particular region, and in that particular region they'll have multiple stores, because that will help them in uh, maintaining their logistics cost and also increase their operating efficiency. So this is how uh, Devyani stands in terms of their expansion throughout the country. And in terms of metros and non-metros, today metros and non-metros almost equally contribute to their performance. This is important where how they tackle the COVID period. So they were invested in a uh, tea business, which was called TWG, and it was not performing at all. It was loss making at that point of time. They quickly took the decision and divested their investment from that startup. They managed to reorient their rentals, change their menu. Store format rationalization is probably the biggest thing or the biggest advantage Devyani had in the recent times, where they focus more on the smaller formats, because smaller stores helps you in quickly turnaround and faster store development with much lower cost. And then benefit of integration of KFC acquired stores from Yum. So when they acquired some these KFC stores from Yum, it was a cash neutral transaction because they could strike a deal of sharing a little bit, sharing a equity rather than paying cash for that. Then you can see the revenue expansion and cost efficiency here. Store expansion both organically and inorganically. Delivery, they focus more on technology, delivery focused stores. A lot of order comes through the aggregators like Zomato and Swiggy, and drive order frequency and order ticket size. These are the areas where they focused on. This is the geographical presence. You can see in case of KFC, they have predominantly presence in southern and eastern region of the country. And in the southern, they don't have any presence in Tamil Nadu, right? And in case of Pizza Hut, they are all over the country because now with their small store format, they can even open in areas where their competitor Sapphire is there with a larger format. That gives them a lot of edge. Costa Coffee, you can see here, it is mostly in the northern, western, and also the central region of the country. Cluster-based expansion, we have already discussed, where you can see in a cluster, like you can see in the northeast region, over here, you can see so many stores being formed. Then again, in the Delhi area, Noida area, you see so many stores formed. So that is how they intend to grow. Now let's talk about their three main brands. One is KFC. So KFC has operation rights in southern and eastern India and in Delhi NCR region. They are the leading contributor to the performance, and as we have already seen, their contribution margins are the highest at 23%. Devyani pays royalty of 6% to Yum Brands for their KFC business. Now, let's compare Devyani with Sapphire in terms of how the margins are there, how the EBITDA margins are working. So you can see the gross margins in case of both Devyani and Sapphire are almost same. You can see here in FY19, it was 66% and 65%. In FY20, Sapphire had a little bit higher margin, but more or less same. And even in FY21, both Devyani and Sapphire have almost same gross margin at 67 and 68%. But when you come down to EBITDA margin, you can see Devyani doing much better here because Devyani has always been close to 10% EBITDA margin, right? And in case of Sapphire, you can see the margin has gone down to 5%. These are the number of KFC stores you can see in top 12 countries. And look at where India is. This is China, this is USA, and this is where India is. That is the kind of opportunity we have. If we believe that QSR is going to have the future, if you believe that we will have more people going after KFCs, the story has just begun. So from a long-term point of view, these stores should ideally go a lot towards what the number of stores in USA is. Now, this is probably their best thing which they have done specifically after the pandemic, which is small size stores So they have reduced their size from 2,500 square feet to 1,500 to 1,800 square feet. So by reducing that, what has happened is they have managed to reduce their rent, and on a reduced store size, they have continuously maintained their ADS. Okay. Average daily sales. ADS is average daily sales. And that leads to a much better overall performance for KFC. Now the seating capacity you can see has reduced from 150 per store to 60 per store. And just look at how quickly they have been able to change the sales mix. Okay. Earlier, only 11% was delivery based. And look at the 9-month FY22 performance. 46% have come from delivery. Of course, now that there is no lockdown, you can expect some sort of a normalization over here because people will go into dine-in as well. It will not be as high a delivery today compared to what it was in, say, Q1 and Q2 of FY22, right? But delivery, the higher the share of delivery is there, the better it is for the company, because in case of delivery sales, they make better margin and it requires lesser working capital involvement. Some other observation for Devyani. Of course, competition to rise in case of their chicken category. Now, Jubilant has recently started their Popeyes store in Bangalore. And they have very aggressive plans over the next 2-3 years, 5 years for that particular brand to grow. Now, if you look at the history of Popeyes in US, it is among the top 3 chicken brands, chicken branded QSR in the US. So just because McDonald's and KFC are already there in the market, it would not be right to assume that Popeyes will not be able to enter the market, right? Plus, Popeyes will also get advantage from the already wide distribution of Jubilant's Domino's store, right? So that is one thing which we have to keep in mind and have a look at. So management over here guides that the market is big enough to sustain growth. See, management will always say something like that. And there is some element of truth as well, because the kind of growth you will see in terms of these QSR categories, you tend to believe that, and it's fair to believe that there is enough space for a third player here. But that doesn't mean that we'll take a very complacent view of this particular category. We have to keep on watching, because if Jubilant has entered this category, it is fair to assume that they will be very aggressive in particular this region or this category. And the third part is all their international stores are predominantly KFC stores only. Now let's come to the second brand for Devyani, which is Pizza Hut. So Pizza Hut started along the same time when Domino's started. And even though they both had almost similar quality, but because of the strength of the business model of Domino's, Pizza Hut took a backseat and Domino's just flew. Right? So, but over the last 2-3 years, specifically after one of the top executive of Domino's joining Pizza Hut, Devyani's Pizza Hut team, they have made some really good changes. They have started focusing on the delivery business, and that has shown some improvement, at least in terms of getting more and more small size stores getting formed. You can look at the gross profit margin and the contribution margin here, and over here also they pay a royalty fee of 6%. Right. So this is how they are trying to change Pizza Hut from their earlier avatar, which is, as you can see here from the quote of Ravi Jaipuria, the chairman, Pizza Hut is basically not dine-in now. It's a delivery store, but if anyone wants to eat there, we just give them the box. So there are still some stores of Pizza Hut where those dine-in system is followed and you get all the cutleries and all. But all the new stores are opening in this kind of format. So when you are shifting to something like this, it is always going to benefit in terms of your operational expenses and your margins, because every little things add up when you shift from delivery to dining, right? So over here, since they are shifting from dining to majorly delivery based, they are going to save a lot on those operational costs, which will go down. And they had a target of opening 100 new Pizza Hut stores in the whole year, FY22. But they managed to achieve it in the first 9 months itself. So again, just like KFC, you can see a comparative analysis of Devyani versus Domino's and also Sapphire. So you can see Devyani has a non-exclusive right to open small size store across the country except Tamil Nadu. This will be very interesting to see how it plays out over the next 2-3 years. Because what this means is that Devyani can open small size stores even in a region where Sapphire already has a large size store. And because of being small size and more agile, it would be and only delivery focused, it would be easier for these Devyani's small size stores to eat into the market share of Sapphire. But how will Sapphire tackle this is something which we have to watch out for. Now, if you look at the gross profit margin and EBITDA margins, you can see Domino's is by far the leader, both in terms of gross profit margin and also in terms of EBITDA margin. But when it comes to EBITDA margin, Devyani is ahead of Sapphire because of their operational efficiency. So some other observations on Pizza Hut is that now the increased role of aggregators are there. Now, this is an interesting point. While while Domino's has its own app, Devyani doesn't have its own app. And in the con call, when analysts asked about it, they said that it is expensive to have their own app and to invest in that technology. So their cost goes up, and that is why they rely more on the aggregators. So this is something which is a little tricky thing. If you are only focusing on aggregators and not building your own app, your brand can never have that kind of a recall which something like a Domino's has. But they also probably didn't mention this in the con call, is that if Devyani has an app and similarly Sapphire also has an app, how will a consumer order in their app and still get it delivered? That is something which is going to create a problem. And that is why they are focusing more on the aggregators, is what we feel. because in the con call they mention about the cost part and it is easier to manage through aggregators. But we feel that when you are increasingly focused only on aggregators, you are faced with a risk where aggregators down the line can charge you much higher fees, right? Like what we see in case of Uber and Ola. When they entered the market, the price of as in the the travel cost was much cheaper. But today, if you see, since all of us are now used to traveling in Ola and Uber, you see how the fares have risen over the last, say, 3-4 years, right? Similar thing has already begun to happen in Zomato and uh, Swiggy. Now they can actually have a much higher bargaining power against the Pizza Hut guys if Pizza Hut doesn't have any app on its own. So these are the revenues. You can see revenues, ADS. Some increase in the ADS is seen here. From 45,000 daily sales, it has increased to 47,000, right? And then the third brand which they have is Costa Coffee. In case of Costa Coffee, they have 50 outlet. They have the best contribution margin in terms of 32%. Even gross margins are much high. And generally, you will see in all the QSRs, the coffee or the beverage section will have a much higher margin compared uh, to any food item, because it requires less investment. It it turns it turnarounds much faster, and you can uh, get your money payback in a much shorter period of time, right? So they spend around 2% of sales on marketing of Costa Coffee. It has healthy margin, but due to temporary closure of airports, the reduced the store count from 67 to 44 and during the pandemic, and now added 6 new stores in the last quarter only. So they have just signed a new agreement with Costa Coffee to increase the pace of the store openings. So these are about the other businesses. So predominantly the three businesses or the three brands which we have discussed in case of Devyani, they cater to uh, close to 90% of their business. And international business forms a very small part today. They have 28 stores in Nigeria, 18 stores in Nepal. Majority of them is KFC. And all the cash flows which are generated through these stores, they are plowed back in the expansion of more stores in the international market only. They also have a South Indian QSR chain brand, which is Vango. And in case of during the COVID, the operations got affected, and because it led to a closure of some malls. Today, there are 27 Vango outlets in 8 states, 1 union territory, across 15 cities in India. Before we go into the management's key focus, commentary, and guidance, any questions or any points anyone wants to ask?
Hi, Ankit bhai, Avadhut here.
Yeah, please go ahead.
One thing, this Sapphire and Devyani, can they have a differential pricing in areas? If they are operating in one area, can they have differential pricing?
As far as what the agreement they have with Yum brands, they do have this policy of they can change their prices.
Okay. So if lower stores and lower cost structure, if they can offer differential pricing, then they can gain market share in that.
Right.
Okay. Understood. And EBITDA margins comparison in the case of KFC versus other thing, uh, uh, KFC having higher margins is because of all these reasons, stores or any other else.
Sorry, I didn't get it. Can you
Uh,
repeat the question again?
EBITDA margins slide which you presented about KFC having a higher EBITDA margin or the Devyani having higher margins as compared to other brand. What could be the reasons for that?
So the reasons, mainly the reasons is operational efficiency because of having more and more smaller size stores, getting more and more delivery based sales nowadays, and also renegotiating their rents during the COVID period. So these are some
Understood.
of the reasons.
But these rents will come back in the or would have come back in the recent quarters, right?
As of now, it has not come back, but there is a chance that it may come back, say in FY23.
Okay, understood. Okay, thank you.
Thanks, Abdul. Any other question from anyone? Did anyone ask any question in chat? Okay, nobody asked any question. Okay.
Hey Ankit, this is Amar.
Yeah, Amar.
Yeah. So one thing which you mentioned is even at a location where Sapphire might already have a offering where Devyani can come in. That is kind of a coup, right? Means this is not a question. I'm just thinking aloud because what happens is there is a master franchisee which is the Yum Brands and it is kind of giving. So this kind of falls under non-compete, right? How did Devyani pull out this scoop? Because this is where they directly benefit, but because of their lower footprint, they will have like lower OPEX, and because of that, then they get more profits, right? But at the same time, Sapphire has taken a big hit, and being a listed company, that would dent its image as well as profits and everything, right?
Yeah, that's a fair point, Amar. I really don't have any answer to this, how they managed to do that. But
Yeah.
we'll try to find this out and we'll let you
I
know.
would like to add something, but that's the thing about non-exclusivity, right? Since they have given rights for non-exclusive store, so they also knew during that time that there might be a better competitor in their space in the coming time. And it is not that Sapphire is listed now and so Devyani has changed its strategy. During DRHP, in fact, they also mentioned that we have the right to open the stores in areas where Sapphire is already present. So market won't change its perception as such because it is all present in the prospectus itself. So it has been priced accordingly.
Yeah. Thanks, Dhruv. Any other question, Amar?
No, I'm good.
Sir, actually,
Terence,
one thing.
I saw your hand being raised.
Yeah, sir, actually, the one question that I have that, actually, I don't see any price difference, actually, when somebody actually dines in and somebody takes the delivery, there isn't any price difference, actually, on the menu front. So I don't know actually how it works actually abroad, but, actually, it's not basically a question, but actually it's something actually, can this, change the things, actually, towards the delivery and takeaways, anything on that?
Are you, if I understood your question well, you mean to say that there is no difference between the price in dining and delivery? That is
Yes,
what
yeah,
you're saying.
takeaway or takeaway. Actually, there should be actually, and I had heard actually, from my friends that actually, in abroad, actually, if you are actually dining, dining in, actually, the price of the same pizza, actually varies, dramatically and significantly. I would say, actually, compared to the takeaway. So, is there anything actually, on the cards actually, from them, and that could, significantly tilt, the business towards the delivery or takeaway, because Indians are basically value conscious. So even a difference of 10, 15, 20% actually, can shift the things, towards that. Any thoughts
So
on that?
you mean to say that if delivery is priced lower compared to dining, right?
Yes, obviously, sir, it has to be like that. Actually, somebody is using the amenities and ambience and everything. So it works that way. Actually, in abroad, actually, I haven't gone to, but actually, my friends are saying it. There's a significant difference in the price.
Yeah. So this is something which has started happening in India in a recent time only. So ordering and getting it delivered or taking a delivery or like just ordering and picking
Yeah,
it up from their store. This is a concept which was always prevalent in the Western countries. Say in the last 20 years, 30 years, many people were already doing that. But in India, it has been a very recent thing. So maybe what you are saying may happen in India as well. But as of now, we don't see that they are pricing it differentially.
okay,
In
sir, got
fact, in
it.
India, they are actually trying to ensure that they increase a little bit prices during delivery period because they don't charge a lot for delivery now. So what they try to do is they use some price differential to ensure that the margins in both delivery and dining are similar. Because currently, due to economies of scale and all such fixed costs and all, the margins in the dining segment are higher for them. So that is one very interesting thing playing out with Devyani as well. Because now, although the delivery is at a very good stable level, but since the dining portion will increase, so that will ultimately lead to overall EBITDA margin improving from now on. So one can't compare this model with abroad since in abroad there's a different stuff, right? But in India, they are trying to first increase the adoption for delivery mode. So what they did initially was they gave a lot of promotional offers so as to ensure that adoption happens. But now after COVID, it's more or less a necessity these days to order food through delivery mode rather than going offline. So I don't see a lot. In fact, they are trying to charge a lot in delivery portion so as to ensure similar margins. So I don't think that will happen here. Or rather, if everything is going to happen, then the delivery portion will be a little bit higher due to the delivery charges.
Got it,
Thanks,
sir.
Dhruv.
Thank
Yeah, Avdut.
Yeah, the expansion of Popeyes would be the interesting thing because as your slide, I can see that in the east and south, KFC is present already. So the test have been developed during in the people. So it is
Right.
difficult to replace what the test has been developed. So we can have a watch at how Popeyes expansion happens over the period. That's the point I wanted to mention.
You mean to say it will be difficult for Popeyes to expand?
Uh, Not difficult, but we can see how it expands. Whether they expand in the similar region first or the different region, and then
Yeah.
they come back to. So it had happened. If you remember the case of Bonvita and Horlicks. If you go to south, you will find Horlicks. People drinking Horlicks more in the Maharashtra and other regions. People will be drinking Bonvita or the Boost. It
But
is
KFC is there all over the country, na? So
yeah.
only Devyani has its territory in south and west, south and east. But
Okay.
if you combine Sapphire, KFC is there all over the country.
It's already there. The in the
Yeah, it's there.
remote places also it has already penetrated.
No, not remote places, but
Okay,
all the big cities and
cities
towns.
there.
Yeah, it's there, na?
It, it would be interesting how they can scale up. Jubilant can scale up and how they
See,
can.
Jubilant has an advantage of its own app. It has an advantage of wide distribution, and plus, they can because they are already profitable, high cash flow generating. They can also penetrate through lowering their prices. So there are
Correct.
many levers they can use to compete with KFC. That is
Correct.
how it is interesting to see how the market will react. So one way of
Correct.
thinking is what Devyani's management is saying that probably we will uh, there is enough space for three players, so we will not
Mhm.
have any issue.
Yeah, yeah,
That can also play out, but
definitely.
only time will tell, right?
Yeah, and as Dhruv was mentioning, this is play of operating leverage, right? once you
Obviously,
cover Once you cover your shops and all stuff or the cogs you cover and the
right,
volumes you make, and then only you will be much more profitable. So volume is the play in this case and the
right,
efficiency of it.
right. Yes, Kailash.
Yes, sir. The one thing that I would like to add actually, it is the pizza actually constitute roughly about 25% and chicken category roughly constitute about 15%. So roughly it is 40% that Devyani is catering to. So my question is actually, the new players like, the biggest players like Fasus and the other Indian, other kind of a category, actually which comes into the QSR actually can actually be the case that the major portion, the Q of QSR actually gets into the other categories too also, actually, get expanded into other categories like fast foods. We are actually not discussing fast foods actually anywhere in the picture, but I read actually, recently that actually fast foods is one of the biggest and the largest QSR.
I don't think Fasos is the largest QSR. Of course, you are right in the sense that Fasos is also there and it's a formidable player. Of course, it's unlisted yet. But in terms of volumes, I think Fasos is nowhere close to KFC and Pizza Hut, right?
Probably Fastest is largest in the rolls category. That's it.
So that's a different category altogether. Rolls,
Correct.
right?
I would also like to add here that Fasos is also going in a quite a different model than the normal QSR guys. The normal QSR guys are mostly looking for a cluster based approach based around their small store. While Fasos, I think they used to do the store format at first, but then they saw that okay, the capex model and everything is too high. So rather than that, they are going more of a cloud kitchen way. So, they would be a big threat to the entire QSR industry in general itself, given that okay, they are also doing a parallel thing, and also they are going into moving into segments which are not being addressed by the normal QSR players like rolls and biryanis and all.
And
But
healthy.
the rolls and biryanis are very I would say in my personal opinion, it is a very I would say very diverse taste, because if you go to the east of India, they have a specific taste profile for rolls and biryanis. If you go to the north of India, then they have a specific profile. Jabki for
Right.
pizza, the taste profile is almost the same everywhere. For burgers, the taste profile is almost the same everywhere. So the challenge for them would be probably standardization of the product and acceptance of the standardized taste rather than direct competition with these guys.
Very good point, Karan. And another thing is that when you look at pizza was always there in the West. But when you see rice as a category, India as a market has a much more acceptance of rice. So many of these QSRs do not have anything related to. So like Domino's doesn't have anything related to rice. So those are also under-penetrated categories where QSR as a whole sector can still see a lot of growth. So that's why Pasos also has its own way of finding its way in this market.
Yeah, I think even KFC is looking to get into the rice game, because they are also introducing more and more products which are geared towards say a rice bowl or something. But exactly I'm not sure whether it would be a direct threat to the original biryani guys, because the whole taste profile difference becomes quite different, because KFC and others are masters at their own game, but this is a
Right.
new segment that they are getting into. So like whether people will try or not, and whether people will accept or not, is a question that we'll have to see.
Right.
And even Jubi is entering into the rice segment through its brand Ekdam. So
Right.
we are, I think, going to see an increased traction towards that segment because it's largely underpenetrated. We don't have any specialized QSR chain for any biryani or kebab other than Barbecue Nation or 2-3
Right.
others.
So
Right.
it's like basically a platform, and you can launch as much as product you can. If something hits, then it will be. It's like VC funding. You put it
Exactly.
on.
So Domino's is doing the same thing right now. Right. You are right, Abdul, in terms of comparing it with VC funding. Once you have made up your mark in one place, you keep on trying other places. It's just like making incremental bets,
Correct.
and if one of them clicks, say for example, if Popeye clicks for them, that would be a good thing for Jubilant, and
And
they would be fine if one or two doesn't do well.
correct. I think Burger King is doing it in the same store. They are launching with other stuff also. We can check it into your next presentation.
Yeah. So they are also doing those things, right? Yes, Kailash, you still have a question? I see your hands being raised.
No.
Okay. Thank you. So let's continue. So coming back. So some more discussion or some more understanding about how the management is thinking about their business. So if you look at their per store capex, it is around 1 to 1.2 crore. This is on a consolidated basis. Of course, KFC stores are priced higher compared to Pizza Hut stores, and they have a guidance of adding 200 stores annually. Of course, this year there would be a little higher because they didn't anticipate that the store opening would be so fast during the last 9 months. So that is how they have increased their store addition for current year with 50. Now they also have this cross brand synergies by opening Pizza Hut and KFC stores in the same location, because it allows them a good bargaining power when they are signing their rental agreements. And another thing which helps them is their supply chain. If you have only Pizza Hut at one place and only KFC at other, your logistic cost would be much higher. And when you put them all, put both of them at the same place, then your logistic cost goes down drastically, right? Because the same guys who are providing or are serving to these people, KFC would serve to Pizza Hut as well, right? So primary focus, of course, would be on Indian market, because abhi tak India ka market is still underpenetrated. There is still growth. Pizza Hut has much higher delivery time as compared to Domino's due to the lower store counts. However, it believes that the delivery time will reduce in the coming years as it achieves scale. So we could expect that to happen over the next 1 or 2 years. But this is also one important point which we have to keep in track. If over the next 2 years they are not being able to reduce their delivery time, then that means that something is going wrong here, and it will impact their performance drastically, because time and convenience is very important in these kind of categories. If Domino's is offering at less than 30 minutes and you are not being able to offer that, that means you are somehow going to lag behind. So they have to do much better in the coming 2-3 years. So generally what they have said, that they have been able to pass on the input price hikes as well, so that they can maintain their gross margin. And post-COVID growth will improve the in-dine contribution. So in the last 9 months as well, there was not the in-dine portion of the market was not at its normalcy. So maybe probably Q4 would be the first quarter where you will see that normalcy creeping in. Surprisingly, in case of Devyani, right now, dine-in has a higher margin compared to delivery. Probably the main reason for that, I think Dhruv also mentioned this point during the Q&A session, that the main reason I would say could be their dependency on aggregators, where they would be charging a commission to them to deliver their goods. And also, in case of delivery, they don't have too many delivery-based stores yet. So that is how it makes difficult for them to scale up their delivery as of now. Once this small size stores get scaled up, probably the cost of delivery will come down, and then probably you will see a higher margin in case of delivery compared to dining. Negative working capital is something which is known to all of us. They sell in cash, they hardly keep any inventory, and they get some time to pay off their creditors. So of course, almost all these QSRs, they work with negative working capital, and that is what makes their business also interesting from an investment point of view, right? As we discussed earlier, revenue contribution from core brands like KFC, Pizza Hut, and Costa Coffee is 96%. And gross margins have improved due to economies of scale and change in employment model from fixed to variable. Earlier, they were giving fixed salary, and now they have made it in terms of hours worked. So that helps them in lowering down their cost. This is the metro non-metro ratio, almost equal as of now. So now we'll come into Burger King, which is now called as Restaurants Brand Asia Limited. First of all, a brief overview and some important points from the franchisee agreement. So it is the master franchisee of Burger King in India. It compared to Devyani, where Devyani you could see that it was a non-exclusive agreement. Over here, Burger King has an advantage of having an exclusive agreement. Exclusive right of operation across India until 2039. We'll see in subsequent slides about their great growth, but just look at this number in terms of they started only in November 2014 and they already have 300 stores in their name. You can go back and check history of history of Domino's, history of all other QSR. No other QSR have been able to grow their store count at this kind of speed. In fact, in their franchisee agreement, they have it has been mentioned that by FY26 they will have to have 700 stores. Even in case of royalty, you will see right now they are paying somewhere around 3% of royalty per sales, and it is also capped at 5% until 2039. When you compare this with other QSR, it is at a lower end only. 5% store revenues to be invested in marketing and advertisement, and one-time non-refundable fees they have to pay at the time of opening a new store. So earlier it was $15,000. From FY20 to FY22, it became $25,000, and 23 onwards it is $35,000. And the maximum debt to equity ratio which they can keep as per the agreement is 2:1. Now coming to the important part, which is Whopper Burger. Whopper Burger is a new category of burger which was launched by Burger King. It is flame grilled patty. It uses flame grilled patty. Now, generally the patties which are used are fried. So fried patties are much more harmful for our health compared to a flame grilled patty. And that is where it caught an attention of so many consumers, and that picked up and improved their brand recall and brand image. And you can see the image over here, and if you can see the patties, if you have, I don't know how many of you have gone to a Burger King store or outlet, but when you compare this patty with the patty which you find in, say, a McDonald's or KFC, it's completely different. Store count you have already seen. So just look at how they are growing their stores at breathtaking speed, and they'll be doubling their store count in the next 3 to 4 years. In fact, more than doubling. As you can see here, Domino's had 400 stores in 2011, and they started their operation in 1996. So it took them, say, almost 20 years to reach 700 stores. Whereas if you look at Burger King, they are already aiming for 700 stores in the first, how many years? I think 12 years, right? So that is how fast Burger Kings. And if you look at the CAGR, no other QSR brand has this kind of growth which Burger King has. Something about their past track record. You can see high sales growth with decent gross margin of 65%. They also form a cluster-based approach. So they have at least 6 to 7 outlets in one ring, which lead to efficient logistics. And they aim to improve gross margins to about 68% in the next 2-3 years by expanding their BK Cafe business, which is a higher margin business, as we discussed in the previous slides, where any kind of food, any kind of beverage or coffee business will have a higher margin compared to a food business, right? They're also going to increase, get the benefit of economies of scale and lower rents. And another thing which works well for them is that they have a well-defined restaurant architecture, which helps them in setting up new stores quickly. So their time of setting up a new store is the fastest in the QSR space. So these are the new initiatives which they have taken. They plan to open 75 stores of BK Cafe in 2 to 3 years. Again, you can see here the gross margins are 80%. It is low capex, payback of only 3 to 6 months versus 5 to 6 years in case of the normal Burger King stores. Now, just like Domino's, even Burger King is investing a lot on app and its own app. In a very short period of time, they have already got 2.5 million downloads. Why they are investing in app? They are investing because they believe that it will help in getting a loyal customer base. Just like we see in case of Domino's. Cost of delivery, they appreciate the fact that the cost of delivery right now would be higher through the app compared to the orders which come through the aggregators. But they believe that going forward with more and more economies of scale, they'll be able to get this cost down, and it will help them have a much better brand recall over a period of time. So dine-in delivery to moderate to 70-30 going forward. That is what the management is expecting. And drive-through stores and high-speed locations are two new things, which new areas where they are trying to open up their stores, which again helps you to probably get a faster turnaround, both in terms of opening the stores and also getting the revenue to the critical stage. This was also in the news, the third point, which is entry into a fast-growing Indonesian market. So they have already invested in this business and bought the Indonesian company which was having Burger King stores there. They funded through a QIP, which was recently done, and they have aggressive plan to just double the total store count in the next 5 years. One good thing about their capital allocation, which we found, is that the management on the con call says this, that I have got opportunities at the 2-3 sites in Guwahati, which will be 3 lakhs, 4 lakhs kind of ADS sites, but are not jumping and going into Guwahati until I build that Kolkata base and then kind of go out from there and build out their outlying cities. So it is a very disciplined approach. So they have this strategy of going only through a cluster-based way. They know that if they have Kolkata as their base, and then it would be easier for them to really scale up fast through other nearby areas of even Northeast and other areas near to Kolkata. But if you just go for a Guwahati, you will end up having a lot of logistic costs which get accelerated to serve the Guwahati market. And you don't know whether in the ongoing period, you will get something in Kolkata or any other nearby market or not. So even though a company or a brand which is growing at such a fast speed, they have this kind of discipline. So just imagine they have not yet started Guwahati. So Guwahati would have been probably one example. There could be other examples in the past as well. So if they would have gone for that, their growth would have been much higher. But they don't want that kind of a growth, because that kind of growth is going to put pressure on their balance sheet, pressure on their cash flows, and pressure on their operating metrics. So that is how a kind of disciplined approach they are making here. So you can see here the number of stores, how it has grown phenomenally in the last 3 quarters. Similarly for their ADS and gross profit, as more and more people started, as more and more people started eating out, and economy started moving out after coming out after the lockdown in Q1 FY22. You see their occupancy level going up higher, and that is evident in their gross profit margin as well. So this was about Burger King's. We have not yet covered the financials and the other key metrics, which we'll do at the end after covering all the 3 companies. Now let's look at Jubilant FoodWorks. So in case of Jubilant, before Jubilant FoodWorks, if we can probably take some questions on Burger King's, if anyone has. Any questions? Anyone? Yes, Kailash, please go ahead. Kailash, I see your hand being raised. You have any question?
No, sir. Actually, the only hello.
Yeah. Please go
Yes,
on.
sir. The only correction, actually, from the previous discussion was that actually Fasus is the largest Indian origin QSR. Actually, that was the only correction. Actually, it's the largest Indian origin QSR, and actually it is really expanding well, and the kind of the response that they are getting. So it can be a kind of a competitor. Actually, that may come out, maybe with the flying colors. Because the kind of that's the only thing actually. Regarding Burger King, I'm the most regular visitor, of the Burger King, and I can say that if they provide the details of their ice creams also, and because I love their each and every item. My kids, actually they never ever go to McD, because they are both maybe 100 meters away, McD and Burger King. The distance between these two things only 100 meters, maybe 200 meters, but they would never ever actually prefer. So
why
McD, so
can you please elaborate as a customer, why do you find Burger King better than McD, or your kids find it better than McD?
basically
Specific?
basically it's the taste buds actually matter actually. And on ice cream, actually I think I can bet on this thing that McD's ice cream is not genuine ice cream, I can say. And if anybody with a with the right senses, actually if they tastes both the ice creams of McD and Burger King, it's a huge difference, I can say. And I can bet also on this thing that the ice cream sales would be very decent compared to the because I had seen people only going for ice creams.
Oh, okay.
I had seen people, and that's the point actually I was just trying to make, and I'm very, very happy the way they are actually. That is my personal take. It's going to be one of the best player actually. This is my personal, actually take absolutely. I love their products a lot, and the app thing that you talked about, they offer really peculiar deals. Kids really find them very genuine, very authentic, because actually of a decent level, so they understand the deal also. Say they find very logical also. So the kind of the offering that they offer, and the kind of the taste they offer, and with the ice cream, it's a plus, huge plus, I would say. I haven't gone tasted their cafe, so I believe actually when it comes to quality, and I had seen the technical team working in a corner, when it comes to the sizes of the burgers and everything. I had talked to them because, they are from, they are, regarding the quality and everything. So their approach is really, really systematic. I had found them. And whereas in MACD, their, desserts never work, somehow, maybe I'm biased, but Burger King is quite class apart, I would say.
Thank you, Kailash. Nice to know your views. Yes, Kamal, I see your hands being raised.
Yeah, so just wanted to check whether you showed in Indonesia as part of Burger King growth, right? So is Indonesia part of Burger King India?
No. Indonesia is a different company.
So you're not
Okay,
audible.
you just showed it for the growth. Okay. So the statistics are all for Burger King India only, right?
Yes.
Okay, yeah, thanks. Yeah, and I will also share one quick experience with Burger King USA. So in Burger King USA for burgers, only Burger King offers the veg option. McD does not have, so I'm not comparing with Subway, but Burger King versus McD. So McD does not have a veg patty option, but Burger King has a veg patty. So yeah, they seem to be slightly more innovative, at least here, in this case.
Any other thing you found, Kamal, in terms of what MACD is doing and what Burger King is doing? Anything which you would like to share? And
So I think
from a general brand perspective, which is a better brand there, Burger King or?
I think the strategy that MACD follows is that it is availability. They are available everywhere. So for example, if you're traveling on the expressways, you will see so many MACDs and you will probably find any Burger King on those expressways. So you have to really search for them. But for MACD, they have this big post and it's very visible as to where the MACD is located. So they have that advantage here. And yeah, so that's the reason why I think MACD is more popular here, availability.
Okay, thanks, Kamal.
As Kailash mentioned, one point about ice creams, if that's the case, it will help to break even faster.
Exactly. I was just about to come to that point of it. So that's a very good point. And these ice creams and coffees and beverages are far better
Margin products.
items in terms of margin, in terms of working capital, in terms of turnaround time, in terms of asset turns. So everything goes better for them in that sense. So
And they're
that is a very
clubbing
good
it
thing.
into the one store, right? They are not like Costa Coffee. There is no separate store in case of Burger King. So that's the added advantage to both Burger King.
Exactly, because you are not going to go for so once you are going to a Pizza Hut or a Domino's or say a Burger King, you are not going to have your food or meal once and then go to a different store to have ice cream. That rarely happens, right?
Correct.
It's better that you have this in-house.
Correct.
And
So it
I have
making
not been
a use of platform to sell different things again.
exactly. I have not been to Burger King much, and recently, though, I have not been to any QSR. But Kailash's point, I agree in terms of MACD. Long back, I used to go to MACD. So MACD mein to, I didn't like their ice cream and all. So maybe I'll go and check in Burger King how good their ice cream is.
You know what, Ankit ji? So in Bombay, there is that MACD at near Andheri station. And the largest selling item for that MACD at that Andheri station was that 5 rupees softy ice cream.
Softy,
Vanilla
yeah.
ice cream.
Yeah. I see that in Ahmedabad also. In Ahmedabad, there is a big mall which is Alpha One. In Alpha One, at the center of the mall, in the ground floor, you will see MACD only having a very small store, very small, where only 2 people are standing there, and they are just serving these softies. One is the vanilla one, and vanilla may you will get that chocolate ka toppings, chocolate sauce ka, right? So that sells really well.
Yeah, and in US, MACD's $1 coffee sells a lot, just for $1. It's like having that chai in Bombay, Raste Wala, like that.
Exactly. Right, right, right.
Smart Things members staying in Mumbai should make a get together at some QSR franchise, I think.
That's a very good idea, Abdul.
We can check the growth prospects of different QSR things.
Right, right, right. So, Chala, let's move to Domino's now. So, we'll not cover Domino's in detail, just like we did in case of Devyani and Burger King. But I think Jubilant at this point of time looks is something which we must look at. And let me share the reasons why we are talking about. So these are some of the basic information about Jubilant, which most of you might already know. It is India's largest food service company, close to
Ankit, you are
1,500
not sharing your screen.
Oh, okay. Okay. Sorry. Thanks, Karan. Let me just. Can you see the screen now?
Yeah, that's perfect.
Right. So Domino's franchisee, we know it's now close to 1,500 stores, 300 more than 300 cities. They have exclusive right not only in India but also in Sri Lanka, Bangladesh, Nepal, and not just this. They have 5 new areas or categories where they have recently invested. And if, of course, Dunkin' Donuts is not a recent one, it has been there for a long time. But Hong's Kitchen, Chef Boss, Ekdam, and Popeyes, all these are niche brand and niche categories where uh, not many people are present. So in case of Popeyes, there is a KFC, but in case of biryanis, not many QSRs are there in the country, right? So if one of them becomes a hit, it can add to the growth engine of Jubilant, where it is already doing really good in the pizzas category. It can easily add another category to its name. Okay. Now, so Domino's was the first company which basically had this figured out really well pretty early in their life cycle, where they focused too much on delivery, focused on convenience of the customer, focused on how to uh, adapt to the new world in terms of incorporating technology, and that is actually helped them to grow by leaps and bounds, right? So I don't want to repeat the Pizza Hut and Domino's thing, which we have already discussed in the last month's webinar as well. So just to get a quick refresh here, if you compare the Domino's and Pizza Hut business, because Domino's focused more on the convenience, focused more on the delivery, kept its stores size small, but made many stores around the country. Quality matters, but not that much, which means is that whether you are a Domino's fan or a Pizza Hut fan, you are more likely to eat out of Domino's than out of Pizza Hut. The sheer reason for that is because it is convenient for you to order for Domino's. You will get it at say 20 minutes at your place. You will find a lot of Domino stores around you. You might not get so many Pizza Hut stores, and that has led to Domino store count becoming 2.5x of Pizza Hut, and revenue you can see is 6x of Pizza Hut. Again, this slide I'll not take too much time because we discussed this in the previous webinar as well, wherein they did a lot of hard work by keeping the delivery in-house, even though they are taking the services of the aggregators. So when an order is booked on a Zomato or Swiggy platform or any other QSR, the Zomato guy or the Swiggy guy delivers it to the customer. But in case of only Domino's, it is the Domino's delivery person who will pick up the order from the store and deliver it to the customer, because they don't want their customers to miss out on that experience, and they don't want to take chance and have more and more control over them, over this whole experience, right? Now, this was something of a uh, uh, we didn't know about this kind of thing. We got this to know 3-4 days back only. That Domino's India has 80 million app downloads. Zomato has somewhere between 100 to 150 million. Swiggy has around 100 to 150 million again. So just try to understand in terms of, so India is a 140 crore population. 8 crore people have downloaded, 8 crore mobiles or 8 crore people have downloaded Domino's. Similarly, 10 to 15 crore have downloaded Zomato and Swiggy as well. Imagine how much of cash burns these aggregators have done over the period of time to get those kind of downloads. And compared to that, do you think Domino's would have done such kind of cash burn? Not at all. And that brings us to this very recent tweet from Naval Ravikant, who is a very well-known VC investor and entrepreneur. He says that you are doing sales because you failed at marketing. You are doing marketing because you failed at product. Because Domino's product is so superior, they don't have to spend too much on marketing. They don't have to give you so many offers which Swiggy and Zomato gives you. Cashback and these offer and Diwali offer or New Year offer. You will not find those kind of offers or those kind of cash burn in case of Domino's. The sheer reason for that is Domino has a focused and much more superior product. So it doesn't need to do that. It reminds me of another discussion I was having with one of our investor friend, where we discussed about Bajaj Auto. So in case of Bajaj Auto, if you look at Rajiv Bajaj, he keeps on talking about his two-wheelers and how he has worked on the two-wheelers, specifically Pulsar, and they try to project how they are much better than Hero Honda, Hero Motors. But if you actually deep dive and look at and try to dissect the performance of Bajaj Auto, you will be surprised. Some of you might already be knowing, but if you have not looked at it in detail, you will be surprised that most of their margins come from their three-wheelers. And why that come? Because three-wheelers has a very good market positioning. They don't have to do any marketing for three-wheelers. They don't have to do any sort of promotion. And it sells on its own. And they are market leader there. But when you look at their two-wheelers only, they find it difficult. And if you look at the margins of two-wheeler, it is even lower than the margins of Hero Motors. That is where you understand that if you have a superior product, you will have you get the advantage of not having to spend too much on marketing and sales promotion. Just try to think in this sense. Domino's today has 80 million downloads, and look at Burger King's. They have 2.5 million downloads. One way to look at it is how far ahead Domino's is already. And another way to look at it is that since 8 crore people already have Domino's, that is a very good target market for Burger King's. If they do their work well, if they continue to pursue their innovative strategies and work around their menus, like their Stunner menu was also a big hit, right? that is where they can increase their app downloads at a very high speed, just like Domino's, right? And once you have your majority of online orders coming through your own app, you get a lot more data about your customer. So like this 8 crore Indians who are ordering through Domino's app, they are getting their data on a regular basis, which helps them in understanding how their customers are behaving, which customer wants what, and they can play around that and customize their offer to those kind of customers, right? Now, in case of Jubilant, there is a sense that probably what we have seen in the last 6 months or so, how the price has fallen. So could be a Maggie-like crisis in just like Nestle saw a Maggie crisis during 2016. Maybe something similar is happening in Jubilant today. So just to give you some numbers, Nestle was trading at 50x earnings. Nestle was trading at 50x earnings in Feb 16, 30% down from its 52-week high after that Maggie crisis hit. And from there, it went on to become a 4x. Now, 50x earnings in February 2016, by any stretch of imagination, was nowhere a valuation where you would be tempted to buy a stock, right? And still it went on to become a 4x from there. And if you look at the last 10-year performance in terms of sales and profit growth, Nestle's sales have probably grown at around 7% CAGR, only 7%. I'm not making this up. You can check on the screener. Jubilant had a similar kind of crisis in the past as well, where in 2016, they saw their price corrected when Ajay Kaul, their first CEO, resigned, and as in first CEO after this, after they got listed in the market. So when he resigned, and until the new CEO was appointed, the same thing happened. The stock price took a beating. So it came down to around 426 at that point of time, and today you know where it is. So it's a, I guess, 7-bagger or around 6.5-bagger from that level, even after this 50% fall. So maybe this is a deja vu where the same thing is repeating from 4,500 levels. It has come down to around 2,600 levels. But try to understand this, that valuation over here is by no stretch of imagination you can think of these valuation as very attractive. Whether Nestle's thing will repeat or whether the Jubilant's own thing will repeat again has a big if. Why big if? In case of Nestle, during that period from 2016 to 2020-21, specifically 2020 till the COVID crisis hit, economy was not growing so well. So when an economy is not growing well, you will have a lot of industrial and capex related sectors which would not do well. It is understandable that more and more market participants or more and more money will flow to sector where there is more certainty of earnings growth, right? But over here today, when the economy is at the position of turning up, there are many industrial or capex related or cyclical sectors which look far more attractive from an investor point of view than something like a Jubilant. So blindly thinking that what has happened in Nestle will also happen in Jubilant carries that important risk or flaw in your investing thinking. But having said that, great businesses which have a secular thing going for them, secular growth, good demand, good branding power, you will find it difficult to get those businesses at really cheap valuation. So whether current price is cheap, from a strictly valuation perspective, it is not cheap. But will you get the share at a much cheaper valuation? That is very difficult to say for anyone. Right? I think there was somebody raised hands. I think Abdut, you had any question?
Ankit, by the series of events, what has happened in Jubilant, that also we need to be cautious.
Right.
First thing what happened was split was there into the stock, if I remember correctly. And earlier there was no liquidity as such. If you look at the volumes or the shareholding pattern, the rise up in the stock could be because of the liquidity or the lower trading volumes also. And once the split happens, most of the times, I could be wrong in this case, some exits happen from the large investors. So it would be interesting to see the shareholding pattern once it releases for this quarter.
Mhm.
And then the CEO's exit came. So this all this series of events what has happened, so we have to look at it cautiously also.
Right, right. Very good point, Abdut. So like the CEO exit, if we talk about, of course, the CEO was instrumental in taking Jubilant where it was today. But one way to look at it is this also, that a company of a stature like Jubilant would not be dependent on one person.
Yeah, I
He
agree.
would have definitely put up a process in place. And of course, every company needs a leader, and eventually they'll find that maybe in the next quarter or so. So that should not be the only reason for us to not look at it. And as you rightly said, these were the series of events which led to the stock price fall. Now, over the next few quarters, as those reasons go away, uh, we would not be surprised if the stock resumes its earlier level because of the kind of growth the sector already has, right? But
Yeah,
the problem is,
business.
yeah, sorry, you were saying something?
Yeah, business point of view, I agree that there won't be much effect. That I agree.
Mhm.
And I would
Right.
like to add that one can't simply attribute its share price performance simply due to its low float, right? If you look at from FY17 to FY21 performance, like when the share price peaked, the share price gave a CAGR of 45%. But it looks very decent. But if one will look the EPS CAGR, then it is close to 48%. So since we know that earnings and share price correlate with each other, so yeah, low float might play a factor, but one can't simply attribute to that because the earning growth has also been very good.
True,
That
true.
is
Yeah,
why I said that.
Yeah. That's absolutely true. All the share price is finally the slave of earnings, but you limit the supply of the shares. The multiplier effect will be seen into share prices.
yeah.
Earnings multiplier effect.
Absolutely. Yeah, yeah.
So both of you are right, Dhruv and Avdut. So Avdut is right that even though in the long term, it is the earnings which counts, but in the short term, uh, by controlling the supply, there could be some movement in the share price, right? So these are some of the key metrics when you uh, see in terms of Burger King, Devyani, and Jubilant. You will see how each of them perform. So in terms of sales growth, you can see there is no doubt Burger King's is growing at the best uh, rate. Similarly, in terms of growth in stores, we have already covered in the previous slides. Even in case of royalty rates, you will see uh, Devyani has the highest royalty rates they are paying to their franchisors or the parent company. In case of Burger King's and Jubilant, the royalty rates are much lower. I think in case of Jubilant, it is around 3%, 3.5%. And in case of Burger King, it is around 4%. EBITDA margin, definitely, since Jubilant has been in the business for last 20 years and they've been able to scale up and get the benefit of economies of scale, their operational efficiency and the the benefit of their logistics, which they control in-house. The EBITDA margin in case of Jubilant is the highest. And in case of Burger King, you see it at the lowest today. But if they continue to grow like this and maintain their gross margins, once they achieve economies of scale and once they see some of their new stores getting matured, these margins should go up for them significantly. So these are the store counts. Now, some key numbers and valuation. So you can see in case of Burger King's, Devyani, you can see if you just take the current quarter sales and multiply by 4 and take an annual number for that, for all these three companies, you can see in terms of sales per store, Burger King is even better than Jubilant. In terms of capex per store, again, Burger King is the highest. Asset turns, Jubilant is the best. And in terms of gross margins, again, Jubilant is the best. But try to understand this. While Burger King can grow really fast by opening more stores because their sales per store is higher, they also need a far more capex to do. And that is why they have also recently done a QIP. Now, whether they should go for they should have taken a QIP or some debt on books, that is debatable. So one way to look at it is that their franchisee agreement says that they can take at least 2:1, at most 2:1 of debt equity ratio. So one way they could have approached is they could have taken debt right now and waited for more expansion before diluting more equity. But I would not be too critical of the management. Probably right now, the kind of valuation QSR companies are getting, who knows, 1 year down the line, 2 years down the line, the multiples may go down. So from a management point of view or from a promoter point of view, it makes sense to probably dilute your equity when the market is pricing you well, or at least, or maybe even overpricing the QSR industry. We don't know yet. But at least from traditional valuation metrics, all the QSR companies are valued at least 5 to 7 times or 8 times sales, so which is by no standard cheap. So from that perspective, the Burger King management has probably done a right thing by diluting stake when the valuations are attractive from a promoter point of view, not from a investor point of view. And maybe in the next 2 years, you will see 2-3 years, you will see they might not raise more equity, and for their expansion, they might raise some debt in their books because they have a lot of leeway now to raise debt because of a higher base of equity in the books. In terms of valuation, you can see Jubilant is around price to sales of 8 times. Devyani is very highly valued at 18 times. And Burger King is the most attractively valued among the three. Now, whether to buy, sell, hold, we never give these recommendations on our webinar. But we sincerely believe that with the kind of discussion we had in the previous month and also today, you will have a very good idea about all the three companies now, and you are in a much better position to decide for yourself. But before you become too excited and too attracted towards this sector, some words of caution. No doubt QSR is a secular theme. No doubt there is a high chance that it will, or a high odds of the sector getting high growth in the next foreseeable future, say about 3 to 5 years. And probably market already recognize that, and most of it is already in the price. Having said that, don't expect them to become value by any time soon. Any company or any industry which is showing a consistent growth in earnings over a sustained period of time with a future outlook, you cannot expect them. Anything can happen. That's a different matter. But odds are really low that you will find them at a very low PE or price to sales. But buying today at current market has little margin of error, according to us. So be very careful of that. And if you are bullish on the QSR theme now, remember the Murphy's Law, which says that nothing is as easy as it looks. Everything takes longer than you expect. Whatever looks really good. So you will see all the brokerage reports over the last 1 year since these QSRs got listed. Everyone is talking about positive. Everyone is giving a higher target price. But that doesn't mean that anything cannot go wrong. So we have seen already in case of Domino's or Jubilant, some things have already gone wrong for them. And anything can go wrong and will go wrong. As an investor, you have to have some margin of error. Even if you wish to invest in any of these businesses and you think that you might not get them at a lower valuation, we would recommend you to buy very slowly in a staggered way and wait for increasing the exposure. Now let's come to the last section of the presentation, which covers risks. So what are the risks for the QSR sector? First of all, we already know it is highly competitive space. We have seen several brands competing with each other. And the biggest threat for them now is the cloud kitchens. So Zomato and Swiggy, they myself have huge growth in their own cloud kitchens over the next, say, 3 to 5 years, which will enable consumers, average consumers, to order from them, because those cloud kitchens will offer products at much lower price. And due to their association with Zomato and Swiggy, they will be available at a much faster turnaround time. So that is where the QSR companies right now have that kind of a threat. The second biggest threat would be cost pressures. And we all know that we are in an inflationary environment. There is no doubt about it. The only doubt or only debate can be how long this inflation can last and how high can this inflation go. That nobody can say for sure. But there is a sort of consensus in this understanding that we are living in an inflationary world. So when we are living in an inflationary world, it is natural to believe that food items will also get. So the biggest raw material they have is wheat. You already know that how the wheat prices are going high all around the world. India is now exporting huge quantities of wheat, which they have never done in the past, right? So these kind of inflationary pressures will be there. Generally, QSRs have been able to pass on the price hike, the raw material hike. But if these kind of hikes remain persistent, then that could lead to some sort of a demand pressure, right? Slowdown in new store opening or app downloads. Of course, this is a business where you need to keep on expanding your reach physically through stores and digitally through app downloads. So any slowdown in those metrics is going to be a risk for them. Changing tastes of consumers. So generally, we know that the reason why QSRs are growing fast, are getting accepted in the society, because it is quick, it is convenient. It hardly takes any time. You just think of it, and in maybe half an hour, you get the kind of meal you want at your place, right? But the kind of food which we eat generally in the QSR category, you cannot term them as healthy. And there could be a case that going forward, our society, through understanding, through awareness, they might resort to more healthy options. Many people I would not say many people, but there are some section of the society who don't go out to eat. Of course, that's a very small section of the society. But what happens if this section grows over the next, say, 10-year, 15-year period, because of more awareness about the unhealthy aspect of these QSR food? And last but not the least, there could be some health related sanctions from government which may lead to some sort of uh, barrier to their growth engine, right? And before we end, let me share with you something very important. So a friend of mine suggested to read this book. I must confess, I have not read this book yet, Salt, Sugar, Fat, but this is a very famous book. And to understand what kind of problem we uh, we face when we are eating out, when we are consuming food made by these QSR companies. And I would request all of you to just Google about Super Size Me. Here is a gentleman who basically did an experiment on himself where he ate only McDonald's meal for 1 month, and that had a very bad effect on his health. And due to that, and due to the his video getting viral, there were a lot of sorry. So there was a lot of discussion all over the US, and several schools and colleges banned these kind of food in their outlets, in their area. So given how we are today with the advent of more and more social media, you cannot rule out this kind of a scenario. Whether it will play out in the next 10 years, 15 years, we don't know. But this is one big risk related to the QSR industry, which one should be mindful of. With this, we come to the end of the presentation. If anyone has any further question, we can take that up.
Ankit bhai, Warren Buffett seems to be the outlier for all this.
Yeah.
He has been eating MACD for a long time, and he is now 91 years old.
I was sharing. You would be surprised, Avdut bhai. I was discussing the same issue of Warren Buffett having this with one of my close relative yesterday only. And I asked her this question: why do you think Warren Buffett, who eats a McDonald's burger every day for his breakfast, and he is still uh, pretty healthy, and even at this age, he's working well? I think the only reason for that is his stress-free life, and he has been doing the thing which he loves for 40, 50 years. Majority of us are not even close to that league. That is why for us, we should be very mindful of the fact that what kind of food we are eating. Of course, it is very difficult to completely avoid QSR in this kind of if you are a part of the society, but you can probably cut down on the number of offerings or the number of sittings you have. Yeah, Kamal, I see your hand being raised, and I think you posted a question on the chat as well. Yeah,
So
please go
actually,
on.
it's slightly side question. So I just was trying to figure out why we don't have Indian food QSRs. Your thoughts on that?
First of all, it is easier to replicate. So, like, I think if you remember, Kamal, in our Eicher Motor presentation, we talked about the 3 stage. The first is proof of concept, second is reputation, and the third is maturity or decline. So something which is already tried and tested in the world, it is easier to implement it in India because you don't have to sell it to the customer. The customer already knows a little bit about it. So right now, with more and more internet being around and social media, just imagine a Popeyes. I didn't know much about Popeye, but when Jubilant mentioned that we are going to start with Popeye store, I could read a lot about Popeyes and know. Similarly, I'm talking from an investor point of view. Similarly, a customer may also try to research and know about them. But when you try to build a brand ground up, it's very difficult. But this is a very wonderful question, Kamal. So that is why if you have an Indian brand, like for example, we discussed briefly about this one, uh, barbecue nations. It is in a strict way, it would not be termed as QSR because the kind of services the kind of food they offer, it takes a little time compared to the other QSR companies. But I would probably assign a higher value, brand value uh, to Barbecue Nation because they started ground up from India. And as Kailash also very rightly mentioned about Fasos, assuming that Fasos is Indian, if I'm not wrong, Fasos
Yes,
is
yes,
Indian
yes.
only.
Yes,
Yeah, it
absolutely.
started by some
Correct.
IITians. Yeah.
So this is
Yeah.
these are much more difficult to do because you don't have any history, and it's much more difficult to sell. I hope you got your answer, Kamal. Or if you have any further
Yes.
follow-up
Yeah,
questions.
Ankit,
No,
I
no,
would also
I
like
was
to
just trying
add
to
here.
connect the dots.
Just a second,
Yeah,
Kamal.
yeah,
You were saying
I
something?
think like Akhilesh has also mentioned it in the chat itself that in for like the one thing common that we see everywhere in every QSR industry in the world is standardization of taste as well as quality of product. Like say for example in India you go to any McDonald's, the
That's a wonderful point.
the
Yes, yes.
the volatility or the difference between the quality of the product in any McDonald's in India is very small. But if you go to like say like the I would say like for me quintessential Indian fast food is pav bhaji. But every city you go, the pav bhaji is different. Similarly, every city you go, the vada pav is different. So
Yeah,
first of all,
that is
the
that is even that is even okay, Karan. The problem lies in South India. People like dosa and idli. In North India, people like chole bhature. So there is so much of diversity around the country. So it makes much more difficult. So that's a very good
yeah.
point mentioned by
Yeah,
Akhilesh
I
and
think
you.
like as you mentioned earlier that it is much easier to accept things which we have seen, which have already been done everywhere else. So
Right.
like building an Indian QSR brand from the ground up is very difficult in my opinion because you already have a catchment area where that product will be popular. But when you are going to other areas where you are introducing that product where it will have competition with the entrenched product in those spaces itself, that is very difficult. But say for pizza was like it was not like pizza was very well accepted first in Kolkata only and then it came up in Mumbai. It had an even starting point everywhere, and also because like as you said that okay it had a very good attraction because it had worked well in the West and everything. So that also like may have pushed it up a bit.
And to add to that, the scalability part of is there, which has not been, which has not happened in the Indian QSR, Indian cuisines. So as you mentioned, current the gradually expanding or the expanding at different cities at same time will have a different effects.
I didn't understand your point. Abdul, can you come again?
Scalability. We haven't seen Indian brands scale at a larger pace. If we look, if we take any Indian food, biryani. So we know biryani from Hyderabad, Paradise Biryani, but they haven't scaled in different cities. Whenever we go to Hyderabad, then only we will eat Paradise Biryani. That's it. We don't hear it in other cities as well. Or the taste point of view also. If they would have scaled it, having the traction they have in different cities, if they were scaled, it could have happened in the past itself. But scalability is also a major challenge, I guess.
Yeah, standardization. So to add to that, see, standardization is a good point because Paradise did start in Chennai, but my friends have been telling me that it's not the same taste that you get in Hyderabad. So I think
Exactly. That is the
standardization
problem.
is definitely.
Correct.
Yeah.
So with the scalability, the standardization also goes out of the whack. If you have the scalability and if you maintain the standards, then only things could work out.
So
So
like Karan mentioned about this, no, pav bhaji,
correct.
the taste of pav bhaji keeps on changing, right? Or
True.
even if you take something like a pani puri, the taste of pani puri changes a lot when you travel from East India to West India.
So
Right.
the founder is the basic movie. If people can watch it on the McDonald's, how it evolved over the period. So initially, how the operations, how they standardized, and how it was a copy paste model going further, and that's how they were able to scale. The founder is the movie.
So
Yeah, it's a
something,
good movie. Yeah, yeah.
yeah, in terms of standardization, if one product which I can think India can scale and standardize is probably vada pav.
Yeah.
Ankit, Italy, ID,
Ah,
Italy. So ID is becoming popular, I think, in Mumbai also. I saw it in Chennai and at Chennai first, and they have a standardization. So maybe because they have a central manufacturing plant from where I
Yeah.
don't know.
Central manufacturing in Dharavi for idli.
In
Cloud
Bombay.
kitchen. Yeah.
Acha, okay, very good.
No,
But
I'm
see,
just
they
kidding.
sell in Chennai also. They sell in Chennai also. I got the same taste in Chennai and I got the same taste in Mumbai. Oh, that's great. Okay.
So in Dharavi, what happens is all these thelas, if you see at Mumbai or roadside, they all will manufacture at Dharavi because your the cost for renting or buying spaces is much lower at Dharavi. So that's the reason. At all stations, all suburbs, all station, you will get same kind of test in Mumbai because it is produced in Dharavi.
Okay, got it. Good point. Yeah, thanks.
I would like
you
to
had
add
some
here
point?
that
Yes, sir.
one,
Actually,
yeah, just continuing on the previous discussion, one another food I would say which has good potential for in the QSR industry and is also like somewhat secular everywhere is probably momos, right? Yeah. So like we can look out for those as well, maybe.
TR is one chain which has been able to scale in different cities or different countries also. I guess in they have in Dubai also they have branches if I remember Saudi
But
and Dubai.
MTR, do they have any outlets?
Yeah. They have in Bangalore. There are you can visit Ankit Bhai. I will share you the address. One at MTR first MTR where it started. The test where there is pretty good. You can visit that.
You'll never get a place to go in and eat.
Yeah. It's that much crowded. MTR is that much.
Sarvana Bhavan. Sarvana Bhavan is throughout the world.
Yeah.
But like that standardization point, the Sarvana Bhavan in Edison, New Jersey is not as tasty as the Sarvana Bhavan in Dallas. And even within Chennai, the Sarvana Bhavan that you get near AMV Studios is best. So yeah, standardization basically is a problem, I think. Yeah.
So so I have worked in the manufacturing industry. So we used to manufacture prototypes at small scale. So they used to perform well on the vehicle testing. And once it goes to mass production, there will be some issues. That's bound to happen. Mass production is altogether a different game.
Kailash, you had a question. Please go ahead.
no, sir. Actually, I just wanted to actually add on this, Buffett actually, point actually that he eats, burgers, and you missed out actually on, he drinks maybe 4 colas and, everything. So, and I had actually read actually quite a bit actually about that. Actually, he talks about it's a mathematical actually. Actually, if a guy needs actually 2200 to 2500 calories, we Indians actually maybe chalo theek hai, actually went outside actually had the burger or anything, then we will be having our lunch or dinner or whatever. So it's
Right.
not as if it's not as if that we had done with our calories. So he takes in that way, and he has confidently said it has got nothing to do with the maybe got to do with the genome genetic sequencing. He would be having in a most desirable way. But other than that, actually, he says actually if anything you eat or drink and you say aha, that can never be harmful. That can never be harmful. So it is just as if that actually you have to be quite calculated actually when it comes calculated actually on when it comes to calorie intake, number of intakes. And another point actually that I would like to add, actually, we may see actually, another force actually, may not be a QSR, but, that is CCD, actually, I had observed CCD also, actually, they are class apart and, in a different zone altogether. But, definitely, the way the things are shaping, I'm sensing, if maybe there are a lot of franchisees not in India at present, but if on having a 500 plus store setup, and the kind of the amount actually anybody can get that kind of a setup in a day one, from day one. So the and anything can happen actually from that angle also. Actually maybe they can rise actually by themselves, or actually anybody can come actually on any given day, and can turn the things ups and downs, so upside down. So I don't know actually how things may work, but CCD can be also one of the decent player.
Sure, Kailash. So we tried to be as objective as possible in our analysis, and we try to speak about all the positives and the negatives. So we are not trying to take any talk about any moral grounds, because that is a very personal thing. And since we are all investors and talking about investment ideas, it is better that we don't talk about the moral grounds and all, because there are people or investors who would also talk about this way, talk about QSR in this manner, where morally it is not good for the society because it leads to health hazards. So that is something which we leave to your own personal choice. So if any other questions anyone has, we can take that up. So thank you so much, everyone. It was again a very lively webinar in terms of the kind of feedback and questions all of you were asking. Any other question, we can take that. One last request I would make to all of you is that we really want our community to grow. So the best way to grow is if you really find our webinars interesting and value adding, please tag our Twitter handle and write a short testimonial that will help us to promote ourselves and have more like-minded investors like you. Okay. So since I don't see any more questions, shall we call it a day? Thank you. Thank you so much, everyone.
Thank you.
And it was great. Thank you. Thank you, Abdul. So have a nice weekend. Enjoy with your family. Bye.
Yeah, bye.
Thank you, guys. Bye. Have a good weekend. Bye.